Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. Starting from this video, we are going to discuss reporting and interpreting stockholders' equity. The learning objective for this chapter is that you would be able to explain the role of stocks in the capital structure of a corporation, compute and analyze earnings per share, describe the characteristics of common stock, and report common stock transactions. We'll also talk a little bit about preferred stocks. You'll be able to discuss and report the dividends and describe the information reported on Statement of Stockholders' Equity. In this particular video, I'm going to discuss a couple of the things. One is the concepts of stockholders' equity. Two is the common stock transactions. And three is the dividend. I'll also mention some other concepts, but these are the three key objectives for this video. Let's get started. If you remember, we talked about capital structure in Chapter 9. When we discussed capital structure, we discussed the costs and benefits of having different types of fundings from either the creditors or the stockholders. So stockholders or shareholders are those people or institutions who own the common stock of a company. Owning a common stock allows the shareholder to have a voice in the management. They can receive dividends proportional to the share of the distribution of the profits. And they also have the residual claim. What is a residual claim? A residual claim is relative to the claims by the creditors. So when the creditors lend monies to the company, the creditors get a fixed return, which is the interest. Remember, the interest rates are always fixed during the year, say 12%. Whatever the companies earn above the 12% would belong to the shareholders. Of course, if the company has a loss, the shareholders bears it. So you can see shareholders are actually more risky in terms of bearing the risk, but they may have a lot of upside profitability possibilities because they are the residual claimer. From the company's perspective, funding from a creditor or funding from debt is more risky because the creditor could force a company to go bankruptcy. Funding from the equity is less risky because the equity holders or shareholders, they request dividend, but it's not guaranteed. So it's less risky for the company, more risky for the common stockholders. A company issued stocks, mostly in the markets. When we talk about listed companies, they issue stocks in the stock markets. Of course, we can have private companies or privately held companies who issue stocks, but they are not sold in the open market. Now, in this chapter, we mainly discuss listed companies. So listed companies issue shares in the stock market. Those shares becomes outstanding shares. For outstanding shares, a company could repurchase from the market. Basically, a company itself can act as an investor, repurchase their own stocks from the market. So that's called stock repurchase. And when they repurchase their stocks, those repurchased shares would be held as treasury stock. This figure formalizes the idea of authorized stock, issued stock, and outstanding stocks. So an authorized stocks or authorized number of shares is the maximum number of shares that a company could possibly issue according to the charter of the company. Let's assume the charter of the company authorized 10,000 shares to be issued. Okay, that is the maximum number the company could possibly issue. Of course, this number is not written in the stone. The shareholders can always have a meeting and then discuss or revise the number. But at a particular point of time, if you look at the charter, there is a maximum number of shares a company could possibly issue. Let's assume the company out of this 10,000 does not have to issue all of them. So let's assume the company issued 8,000 shares and left 2,000 shares unissued, okay? So the issued shares plus unissued shares should equal to the maximum number of shares, which is the authorized number of shares. For among the outstanding shares, right, which is the 8,000 versus 2,000. So 2,000 unissued, 8,000 outstanding. Now in this 8,000 outstanding, later the company could repurchase, right? I sold 8,000 shares in the market, and then the company goes to the market and say, okay, I want to repurchase, say, 1,000 out of the 8,000. If the company repurchase 1,000, outstanding shares will become 7,000 because now 1,000 goes to treasury stock. So outstanding plus the 1,000 treasury stock equals to the issued stocks. So issued, it's basically here. So issued stocks can have two basically status. It's either outstanding or it's repurchased. So the number of shares matters because the number of shares is kind of a way for a company to determine their performance. So for example, we're going to compare two companies' net income. It would be very hard to compare, for example, my company, which is a bookstore, my company's net income with Amazon's net income because Amazon is huge and my company is very small. So when people compare the rate of the performance for different types of companies or companies with different sizes, they come up with a ratio which would eliminate the differences in sizes among different companies. One ratio invented by the analysts is called EPS, earnings per share, which is just net income divided by weighted average number of common shares outstanding. Now you can basically ignore the weighted average part and remembering this as the number of shares outstanding. So net income divided by number of shares outstanding equals to the EPS. In this example, IBM net income for 2017 is 5,753 million, and the average number of shares outstanding was 932.8 million. We are just going to divide the number of shares, divide the net income by the number of shares and reach to the EPS, which means the company earned $6.17 for every single share that's outstanding in the market. Or for an investor who holds one share of IBM, they earn $6.17 per share. Now let's talk about sales of the stock for companies. Companies would issue new stocks, or you can hear this in the media all the time. It's called IPO, initial public offering, which is when the company the first time issuing stocks to the public. Of course, subsequently, a company could issue more stocks to the market if the market wants it. And those issuing would be called SEO, seasoned equity offering, or seasoned offering. Now let's take a look at an example where IBM sold 100,000 shares of common stock. For those common stock, the par value is 20 cents. And the market value of the common stock is $150 per share. Now, what does that mean? That means IBM shares, when they sell on the market, they were sold on the market, they were sold for $150 per share. But on the face, on the paper of that share, it indicates the face value or the par value is 20 cents. Now, what is the par value and what is the market value? Par value does not equal to market value. You already see in the IBM case, par value is 20 cents and the market value was $150, right? Why do companies have par value on their stocks. The idea of par value is that in some of the states, the state requires a company maintain a certain amount of capital called the legal capital. So the par value is set to basically satisfy the requirement of the state to maintain certain legal capital. Of course, some states do not require legal capital, and some companies do not have par value. All right, when accountants record a transaction in the IPO or the SEO or any issuance of the new stocks, the first thing we would record is cash, because we receive cash. By selling the stock for $150 per share and selling 100,000 shares of them, the company got $15 million of cash. Now, this $15 million cash would be split into two parts. The first part is associated with the par value, 100,000 shares multiplied by the 20 cents par value, which is $20,000, would be associated with an account called the common stock. This is the owner's contributed capital in the par value. The rest of the 15 million, when excluding the par value, would go into something called additional paid-in capital, or APIC. APIC is calculated as the number of shares issued multiplied by the difference between the market value and the par value. This is just the premium of issuing the stock, basically. Now, lots of my students ask me, what about the companies selling stocks in the secondary market, right? The secondary market is just the market that you and I, for example, purchase Apple stock every day or every other day. If you do some transactions, those transactions are conducted in the secondary markets. What would the company's accountants do? The answer is that the sales of the stock in the secondary market has nothing to do with the company. After the company initial offering or the season offering is done, the company no longer keep track of the price of the stock in their accounting system. All right, now let's talk about repurchase of stocks. A company could repurchase their own stocks, as we mentioned at the beginning, and such stocks, when they were repurchased, is called treasury stocks. When a company repurchased, for example, IBM reacquired 100,000 shares of the common stock when it was selling for $140 per share. Now, when that happened, IBM paid cash, right, for the 100,000 shares multiplied by $140 per share, that's $14 million. And IBM would debit something called treasury stock, which is not an asset account. Although a lot of my students thought it's an asset, it is not an asset account. It is a contra equity account, which means it's basically working against the equity. Or you can remember it as a negative equity, basically, but it's not really negative, it's just contra equity. So after a while, IBM determined, oh, the stock price goes up, I want to resell some of the stocks just to make money out of it, right? So IBM reissued 10,000 shares, which is 10% of this treasury stocks, and at $150 per share. Now IBM makes some money. The difference between the cost and the selling price would be sort of like a profit. So when it's reissued, IBM get cash, which is 10,000 shares multiplied by $150 per share, that is 1.5 million. The treasury stock, which was recorded on the debit side, now has to be reversed by the $10,000 multiplied by the cost, right? When we repurchase, it's 140. So the cost of the shares is 140. Multiplied by 10,000, that's 1.4 million. And the rest, the $10 difference between the cost and the sales price, would go to the APIC. it would increase the additional paid-in capital or the premium that we just talked about. Now, McGraw-Hill has a guided help video 11-1, which talk about the issuance and repurchases. If you need more details, you can go ahead and watch that video. All right, let's talk about dividends on the common stock. Dividends are basically returns from investing. You know that the banks has returns in the form of interest. Shareholders have the form of return in dividends. Some investors prefer to receive returns in the form of dividend. For example, retirees, they seek stocks that will pay relatively high dividends because they have a relatively shorter horizon to receive the returns. For some other people, they would rather receive stocks with lower dividends because they want the company to keep the dividends in the company and reinvest the dividends into the productions that has higher return. These are the key dividend dates that you need to remember. The first date is called the declaration date. This is the date on which the board of directors officially approves the dividends. When the board approves the dividends, the company needs to make journal entries to record this transaction. So journal entries are recorded on the declaration date, not the payment date. The company would debit retained earnings and credit dividends payable. Now, in some of the textbook, they do not debit retained earnings directly. Some of the textbook would debit dividends. So it is a separate account called dividends. And the dividend account would later close to the retained earnings account. So I just want to bring to your attention, not all the textbook use debit retained earnings as the dividend transaction, for the dividend transaction. The second date is called the date of record. The date of record is the date on which the company prepares a list of the current shareholders who will receive the dividend payment. Basically, this is the date on as of this date, if you have the stock on this particular date, you are entitled to dividends. Now, there's no entries required. It's just who would the dividend goes to. The last date is called the date of payment, when the company pays the dividend. So when the company pays for the dividend payable should go to 0. So the company would debit dividends payable, credit cash. Here is an example. You can pause the video and take a look at the example. The example just reflects what I've just talked about. When the dividend is declared, the company would debit retained earnings, credit dividends payable, and on the date of payment, the company would debit dividends payable, credit cash. On the date of record, there's no journal entries required. Finally, I want to point out there is a type of shareholders who are not common shareholders. This is the type of shareholders own something called the preferred stock. Preferred stock is between the debt funding and the shareholder funding. Because the preferred stocks typically is less risky because they have a preference over the common stock. When a company has some, no matter the company has profit or loss, the company has to pay the creditors, the banks, right, the lenders. The next group of people that the company would be paying is the preferred stockholders. So they have a preference over the common stockholders and get their returns. But however, the downside is that preferred stockholders typically do not have voting rights. And their dividend rate is fixed. That's why they are less risky. So it's not a vote, they cannot vote, but they got fixed dividends. The McGraw-Hill Guided Help video 11-2 would discuss in more detail about the dividend policy and how the accountants make the transactions and record them in the book. So I would encourage you to watch that video. Alright, this video concludes the chapter, also concludes the semester. I hope you had enjoyed this accounting journey, and I wish you the best in your future academic endeavors. Goodbye for now.